in the following weeks? These are the questions that people will be asking.
I think the more interesting question is, can you imagine a 144? Something pushing 200. If we got something much, much stronger, that would feed this idea that we're getting this reacceleration. I see nothing like that in the data so far this week, with the exception of one thing. That subcomponent of the ISM manufacturing with new orders. Apart from that, there's not much to hang your hats on.
On the flip side, what if you get 50,000 jobs and then you also get the unemployment rate coming down? I mean, there are all of these sort of questionable sort of mixes that leave people scratching their heads saying, what do we do with that?
Let's throw some of these questions at David Doyle of Macquarie. David joins us now for more. David, welcome to the programme. A loan churn dynamic in this labour market. That's been true for quite a while, David. There's been a worry it breaks one way or the other and maybe in the wrong way. How are you shaping things up?
Yeah, look, I mean, obviously we have low hirings rate, low layoffs rate, and I think that's impacting the data in sort of broadly speaking in a lot of ways. The way we're thinking about it actually is, and I think it's the point you folks made off the top, is low labor force growth is I think a big factor here. And you know, when we go back to look at what the economy was doing in 2023 and 2024, you needed about 200,000 jobs per month in order to sort of keep the unemployment rate stable. We think that number's come in a lot. It might only be 50,000 or 75,000 at the moment, potentially even lower than that. And I think that what that means is you can have months of low jobs growth, but still have a steady unemployment rate. And I think that's, you know, largely shaped the data over the past 2 or 3 months.
David, is there a contradiction here in the idea that companies are accelerating their profits while not necessarily growing their workforces? Does that have to change, or is this the new reality?
Look, I think I agree with the notion that things will break one way or the other. Like, I think we either see a deceleration eventually or a reacceleration. So I don't think that I would be cautious in terms of using the terms new reality. Now, it's possible that we stay in this regime for a few more months, maybe into the end of this year. But by 2026, we actually are fairly confident that you're going to see the economy start to reaccelerate as you get some of the impacts of the One Big Beautiful Act taking effect, and as you start to see, likely, in all likelihood, in our view, some of this policy uncertainty come in a little bit to give more confidence in the outlook.
It seems like a lot of people are talking about the economy breaking to the upside. How much risk is there of it breaking to the downside at this point, given that very few people are talking about that, and that's not what's currently being priced into risk assets at all?
Look, I think in the near term, there are risks of that. I think that there are headwinds over the next few months to real income growth, real wage growth, from the likelihood that we get this tariff price pass through. That's going to weigh on real consumer spending, and so potentially you take a leg down. I wouldn't say a contraction, but certainly lower growth than what we've had in recent months or recent quarters. And so that slowing, though, I think paves the way for a reacceleration in 2026. So I think there's risks of a slowing, but I don't think it's all too severe. And I do think that things start to look better when we get to 2026.
David, you just talked about two issues in Washington. One, the One Big Beautiful Bill, and that could potentially be fuel for next year. At the same time, tariffs, which could potentially dampen the outlook for next year. Do they just equal each other out, cancel each other out?
Well, that's a good question. From we'll assume for now that the tariffs remain in place, right? So there is some uncertainty in that regard. But if you assume the tariffs remain in place, they largely, pay for the deficit or increased deficit impacts that flow from the One Big Beautiful Act. In our view, actually, what we've seen so far this year has been a significant effective fiscal tightening from the implementation of the tariffs that's now causing a slowdown in growth. Once you get to 2026, that tightening, actually, you look at the math, it turns into an easing, right? So you've absorbed the impacts of the tariffs, but then you start to get some of the easing measures that were in place in the One Big Beautiful Act, and that can start to support growth when you get to the first quarter of 26.
Where exactly will we see that support from the One Big Beautiful Bill?
So you've got larger tax refund checks. We think that will flow through to consumers from, no tax on tips, no tax on overtime, et cetera. The other element you could see it in is in fixed business investment, right? You get 100% immediate expensing and other business tax measures that were part of that One Big Beautiful Act. That could provide support in that regard. But, so those are the sort of the sub elements to it. But when we look at it, we just look at the broad fiscal deficit. The broad fiscal deficit has narrowed this year. When you look at the math for 2026, it's likely to expand, suggesting that the government spending and the fiscal policy becomes more supportive of growth.
David, can we just stay on this reacceleration theme? I just want to dig into that a little bit more with you. Is that a consequence of the rate cuts people are expecting, or is this a Fed cutting interest rates into a reacceleration?
So look, I think that it's a bit more nuanced than that. It's a good question. I don't think we're at the reacceleration just yet, right? I do think that there's some more headwinds to come in the near term. So the Fed is almost kind of, if the Fed proceeds with cuts, in our view, they're doing it at the end of a slowdown type of period. Potentially those cuts would contribute to a reacceleration later in the year. But to be quite frank, I mean, I don't really think that the effects will be all that significant. We're not talking about a dramatic shift in policy. The market's already pricing in the cuts. I think delivering, 25, 50 basis points through the end of this year isn't likely to move the needle too much on what we're looking for in 2026.
And just quickly, what's the number you're looking for tomorrow?
Always a mug's game to forecast the monthly payrolls number. I'm going with 100,000. A little bit above
100K. And do you consider 100K in today's environment a good number? Is that more of a structural story and less of a cyclical one?
So it's a structural story, yes. And given the low labor force growth that's currently being experienced, 100,000 jobs in a month could be consistent with a tick down in the unemployment rate. Not saying that we're going to get that, but it could be consistent with it.
Something to think about. David, thank you, sir. Appreciate it. David Doyle there of Macquarie. That was the scenario that you were leaning into before this conversation started.
Because of the low churn kind of dynamic, that even just a little bit of job creation could end up with a lower unemployment rate. The point you were making, is the Fed cutting into a reacceleration, or is the reacceleration on the heels of the Fed rate cut? I'm still thinking about that because ultimately that determines inflation, right? I mean, if they're cutting into a reacceleration, could that just juice things in a way that would allow price increases to become more entrenched?
And juice this market too, a market that's rallied pretty hard coming into September. Equity futures still just about positive on the S&P going into the opening bell 50 minutes from now. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. A recap of this morning's labor market data. Hiring at private sector jobs slowed in August, with ADP data showing 54,000 jobs added in the month. That's roughly half the pace of the prior month and below the median estimate of 68,000 jobs. Elsewhere, weekly jobless claims rose to the highest level since June at 237,000, adding to evidence that the labor market is cooling. Meanwhile, Russian President Vladimir Putin told his Ukrainian counterpart Vladimir Zelensky that he should come to Moscow to hold peace talks. Putin, who was attending Beijing's massive military parade on Wednesday, also claimed he never refused the meeting with the Ukrainian president. And the NFL season officially kicks off tonight with a matchup between the Dallas Cowboys and Super Bowl champions, the Philadelphia Eagles. But NBC is the big winner. The network said this season will be its highest grossing yet, having already sold out its ads for the Super Bowl in February. It's also said 90% of its ads inventory for Sunday Night Football. That's your Bloomberg Brief. John?
Some serious money. Yahira, thank you. Appreciate it. Up next on the programme, Subhadra Shapra of SocGen, as the 30-year Treasury yield continues to back away from 5%, and we count you down to an important hearing on Capitol Hill with Stephen Myron from New York City. You're watching Bloomberg TV.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
It's a very, very sluggish labor market, and I think what's important is that consumers are telling us pretty clearly that labor market conditions are deteriorating. My sense is that there's an ongoing sort of labor market slowdown that's already in train. I think we're maybe entering a situation where the markets will have to price in more rate cuts, and that may not be so good.
That was Neil Dutta of Renmac on the programme with us a little bit earlier following a downside surprise on ADP. The jobs number came in at 54K. The estimate was 68. Jobless claims, the wrong kind of upside surprise, 237 versus an estimate of 230. Still jobless claims pretty stable at the moment given the picture elsewhere. The picture elsewhere hasn't been great for this labour market so far this week. Equities look like this going into the opening bell. Equity futures still positive by 1/10% on the S&P. On the Nasdaq 100 up by 0.1 also. In the bond market, things stabilise a touch. Down 2 basis points to the front end of the curve, 360 on twos as this market positions for more rate cuts from this Federal Reserve. Sticking with the Fed, Subhadra Jayapur of SocGen remaining slightly cautious, writing this. While the hope is for lower policy rates to stimulate the mortgage market, that could backfire. We could see a repeat of last September when a 50 basis point rate cut resulted in higher long-end yields. Subhadra joins us now for more. Subhadra, good morning.
Good morning.
Going to pick up on the line of questioning that we finished the last interview. Is this Federal Reserve cutting into strength?
It feels like it, because if you look at a lot of the data that's come in, economic surprises have been to the positive side. The growth momentum into the second quarter is also on the positive side. Inflation is high and sticky. The job market, as Mike McKee was pointing out, there's no hirings, there's no firings. It's in a state of stasis. So to me, it feels like that, plus all of the fiscal stimulus that could potentially come down the pike, could be something that could move the markets higher. So it feels to me like some of these cuts that are priced into the market are more preemptive than really something that's warranted.
Is this something that's tradable now, or is this just sort of warning shot ahead of what could be a tumultuous couple of months?
I think so. I mean, the market's pricing in nearly 6 cuts between now and the end of next year. The markets, people are looking at, a cut and maybe 3 cuts this year. To me, it feels like if they cut sooner and more aggressively, they won't be able to cut as much next year. So the neutral rate is going to have to be a lot higher, given the fact that inflation is still high and sticky, and the risk is that you could see a reacceleration of inflationary pressures. So the market, to me, feels like it's overpricing cuts between now and the end of next year.
Even with the political impetus, right? I mean, how do you sort of overlay any kind of political interference with this, given that right now this is a Fed that has a dovish bias and might have an even more dovish bias by the time we get around to 2026?
So that's the part that's tricky, and I think that that's part of the reason why the market's pricing in 6 cuts by the end of next year. So the market's really looking at what the Fed could do as opposed to what the Fed should do. So to me, it's very hard to really kind of separate the two aspects. One is, if we have a very dovish committee next year, that could really change the dynamics in the market. But over the long run, that, to me, leads to Fed credibility. A lot of times we look at the market and say that, you know, the bond market is very complacent right now. Volatility is very, very low. But you could see a pretty significant sell-off in bond yields in a very short amount of time if there is a crisis of confidence.
But there isn't right now. How much are you going to be watching this Stephen Myron Senate confirmation hearing just to really, as Terry Haynes put it, read the body language of the Senate, which at the end of the day, the purview of the Fed does belong to Congress?
Yeah, I mean, it is important. We will be paying attention to what he's saying, but it's really a committee decision as of now. It really depends on what the composition of the committee is going to be next year, who President Trump nominates to be the next Fed chair. So again, there's a lot of uncertainty, but there's a lot of complacency, I think, in the bond markets. Just going back into the last, say, few years, we've seen many episodes when bond yields have risen sharply. We saw, 100, 150 basis points of bond yields rise after, August of 2023 when, the Treasury issuance, coupon issuance sizes changed. We saw a pretty decent sell-off in bonds even last year when the Fed cut rates by 50 basis points. So, to me, it feels like there is just that feeling that everything is going to be status quo when there's just a lot of uncertainty coming down the pike, whether it be Fed independence, whether it be the trajectory for debt and deficits, not just in the US, but also globally, and other kind of, extraneous factors like tariffs and that working through the legal system.
I think you're building a credible case, but what's been surprising for me is just how stable the Treasury market actually has been.
Yeah.
Yes, we've had steepening in America, like we've had steepening in Europe, but this steepening has been completely different. It's been led by the front end. 10s and 30s have been really resilient relative to some of the chaos in France, some of the chaos in the UK. What's supporting the Treasury market right now? Maybe that's an interesting question to ask. What is supporting this? What is keeping 10s at 420, 30s away from 5%?
So I think that when you look at the composition of where people can invest, I mean, clearly the front end is pegged to Fed expectations. The market is pricing in, as I said, a lot of cuts over the next year and a half. And then when that trade's maxed out, investors kind of move on to the belly of the curve. And the belly is really where you've seen a lot of the flows. I mean, the 2-5 curve actually inverted a few times. You're seeing a lot of demand for the 5 and 10-year part of the yield curve. And investors, broadly speaking, are concerned about putting money beyond that 10-year sector because there's a lot of volatility in the very long end, not just from the debt and deficit trajectory for the US, but also what's happening globally. You're looking at, the picture in Japan or, the political, unrest in France. That all argues for higher long-end yields. So really the center of gravity for the Treasury market seems to be the belly of the curve.
So last year, they dropped rates 100 basis points. Yields rose at the long end by 100 basis points. What are you actually looking for into year end? What kind of number?
To me, it feels like the 10-year yield is still going to stay between 4 and 4.5%. Yes, to me, the risk is that we might actually start drifting towards 4.5% if the market starts to get concerned about kind of the inflationary, impact of tariffs that feeding through, or if there's any sort of concern over Fed credibility. But, the different sectors of the yield curve are still going to remain range-bound. Where I'm really concerned about yields getting unhinged is in the very long end. I think 30-year yields could very easily get to 525. I mean, we saw a lot of volatility in just this week in the 30-year. So it's very conceivable that you start seeing, that sort of, concern play out in the very long end of the yield curve.
Saw a massive range yesterday in just yesterday's session. Subhadra, appreciate it. Thoughtful stuff as always. Thank you. Subhadra Rajappa there of SocGen. 30-year bond yields very close to 5% in yesterday's session, within a basis point. Now back down to about 4.87 and down 3 basis points on the day. Let's talk about the big event. It takes place in about an hour and 7 minutes time. Fed pick Stephen Myron preparing for a grilling on Capitol Hill. Tyler Kendall joins us from Washington for more. Tyler, walk us through the procedure here, the process down in Washington.
Yeah, hey, John. So Stephen Myron will be in front of the Senate Banking Committee starting at 10 a.m. Eastern. This is the first step in what we're expecting to be a pretty expedited confirmation process for Myron. And today the spotlight's going to be on him and his bid to try to reassure lawmakers that he's committed to the central bank's independence. But I'll also point out that we are closely watching some key senators here because this is really going to give us a rare glimpse into how some of these Senate Republicans are balancing their prior support for Fed independence with their current support for for President Trump. And while we're not expecting any Republicans to vote against Myron, I will say my eyes on some key ones like John Kennedy, Mike Rounds, Tom Tillis, who actually met with Myron last night, because these have been the lawmakers that are perhaps a little bit more staunch in their support for the job that Fed Chair Jerome Powell has been doing. Now, with that said, we got the prepared testimony from Myron. He's going to give brief remarks before he takes questions. And in that prepared testimony, as you've been covering all morning, he says he's going to be committed to preserving Federal Reserve independence. But with that said, we know that there's this paper that he authored last year where he suggested that there should actually be more presidential control over the central bank, putting forward some perhaps controversial changes, including potentially changing the term limits of Fed governors and subjecting the central bank to the congressional budget appropriations process. John, at this point, Democrats have conceded privately to us that they don't have a lot of procedural options to really stall this vote ahead of the September FOMC meeting.
Tyler Kendall with the latest. Tyler, thank you. Looking forward to the coverage down in Washington, D.C. As we've said a few times, credibility here is important. And it's not about gaining credibility with the people in the room. There's an obvious and clear political divide down in Washington, D.C. No point even discussing that. It's about having credibility with the market. And as Neil Dutta said, having credibility as well with your future colleagues, some of which are still very much on the fence when it comes to September and cutting interest rates.
Given some of these big questions, you pointed out that Treasury yields have been remarkably stable. So while people are fretting about it, there has been a stability in the bond market. I ask why, and it's because of this two-sided risk. On one hand, you see the labor market data coming in soft enough to get people worried that maybe things could break to the downside, while people are thinking, well, hold on a second, maybe this is going to be a central bank predisposed to running the economy hot, which could be the other way around, cutting into a reacceleration. That is the tension keeping things in stasis.
When it comes to credibility with his colleagues, it's going to be very challenging in the sense that this is someone who also wrote a paper about the revolving door between the Fed and the White House.
Yeah.
There's an open question that maybe he goes back to CEA after the short stint at the Fed.
That hearing, an hour and 4 minutes away. Coming up tomorrow, full coverage for you. Chris Ferrone of Stratega, Sarah House of Wells Fargo, Nadia Lovell of UBS, Stephanie Roth of Wolfe Research. The Jobs Report up next.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
A cidade estava sitiada.
Isso ao começo eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Nasseri, and Los Angeles royalty Will Obey. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Back to within 1% of all-time highs, despite the jobs data coming in thick and fast, mixed results. 30 minutes until the start of trading. I'm Danny Berger. Matt Miller is off. Bloomberg Open Interest starts right now. Coming up, AI anxiety, a tepid outlook from Salesforce fails to impress, heightening the stakes for results from chipmaker Broadcom. And it just might be the hottest ticket in town. Tech leaders, including Zuckerberg, Cook, and Nadella, all set to attend a White House event tonight. Meanwhile, Fed Governor nominee Stephen Miron heads to Capitol Hill as President Trump's threat to the central bank starts to worry investors. Some stocks on the move this morning. Salesforce falling. Investors seeking stronger sales growth from its AI pivot. Again, those tech leaders going to be at the White House today. Figma, also another set of results, down 15.4%. It failed to meet a high bar for its first earnings report. And today, Broadcom's $730 billion rally will be tested with earnings after the bell. But first, we start with Wall Street and a story breaking moments ago. Citigroup is entrusting its wealth business about $80 billion or so worth of assets to BlackRock in a new partnership. Bloomberg's Todd Gillespie reported on the news, broke that story just moments ago, and joins us now. Todd, great to see you. Excellent reporting. What exactly does this partnership look like?
Well, essentially, Danny, this is the last asset manager at Citigroup. The last asset management operations in the entire bank is finally being shuttered, and $80 billion of AUM is being handed to BlackRock. That's a large chunk. That's about an eighth of all of Citigroup's wealth client investment assets. So we're looking now at an environment where banks are increasingly looking to partner with asset managers, looking for other options, looking to do this more efficiently. It's a big part of Jane Fraser's goal at Citigroup to improve returns, streamline its wealth business, increase revenue, and essentially deliver more outsourced products to its clients.
But how much of this is Citi almost backing away from some of the wealth management division in that they're entrusting BlackRock with it? When we've seen other, let's say, basically all of global Wall Street try to double down on their wealth offering.
No. I mean, it's essentially Citi saying we're going to stick to our knitting in terms of they are going to double down on the advisory side of things. They're trying to hire more advisors. They're trying to expand their products to the mass affluent. They're trying to grow their wealth business, certainly, but do it in a way that they know they can do the thing that they're good at, BlackRock can do the thing that it's good at, and everyone can partner up. Notably, Citi, unlike Goldman Sachs, unlike JP Morgan, unlike Morgan Stanley, Citi doesn't have an in-house asset management platform that it can, share products between. It can get, it can kind of has its own built-in partnership, and now it's looking to BlackRock to essentially provide that service in a similar way that Citi in its banking business has looked to Apollo to provide private credit.
Well, to that point, it's kind of the moment of partnerships. Another one that you reported on this morning was T. Rowe Price and Goldman Sachs taking a large stake in them. What is the aim of Goldman in doing this?
Yeah, it's a good question, Danny. And I mean, for a lot of people, T. Rowe Price is seen as a fairly ailing asset manager, right? I mean, hundreds of billions of dollars of outflow we've seen since the peaks of 2021 when T. Rowe Price's shares were up high. I mean, now we're looking at Goldman Sachs appearing to see some undervalued opportunity here in T. Rowe Price, particularly in its position as a leading retirement manager, manager of retirement funds in the United States. Bear in mind, we've seen Donald Trump's administration grease the wheels just recently for banks to start to put more private credit assets, more alts platform products into individual investors, 401ks, retirement plans, and Goldman is looking for more channels to collaborate in order to do that, to make sure that it can get its products into the hands of T. Rowe Price customers as well.
Todd, excellent reporting. Thank you again for bringing those stories to us. That is Bloomberg's Todd Gillespie. Let's turn to tech now, and where we had earnings. Salesforce, after the bell yesterday, projecting weak sales growth compared to Wall Street expectations. That's adding to anxiety around AI's return on investment. Let's bring in Mandeep Singh, Global Head of Tech Research for Bloomberg Intelligence. And Mandeep, I think there had been some real hope that Salesforce investment into AI was providing returns, that people would actually be using their AI agents. So is it not happening? Is it delayed? What's going on?
I mean, look, when you compare Salesforce to a Microsoft, which is, 5 times bigger and growing double digits, the high single-digit growth just doesn't look good enough. And so from that perspective, they called out, adding AI products is just not making a difference. And everyone is comparing the AI revenue contribution. In the case of Microsoft, it's close to $15 billion. For Salesforce, it's less than $1 billion. And so the main question here is, do the AI products get consumed through someone like Salesforce, or are companies building it themselves? Which is why all the database companies did so well this quarter. We saw Palantir, MongoDB, Snowflake. I mean, companies are using their data and building their own AI agents. So the question is, do they build AI agents through Salesforce, or do they build it themselves? And that's what's reflected in the growth right now.
It's a good question, and a lot of questions surrounding tech. And we're going to get maybe more question marks with an event at the Rose Garden. I think the spokesperson for the White House called it like the hottest club is the Rose Garden Club. Yeah. So we're going to have Zuckerberg, Cook, Satya Nadella, among others, at an event hosted by Melania Trump. Do we know what this event is? Do we know what the impact of it might be?
I mean, look, the president had an executive order where they specifically mentioned AI infrastructure as a big priority and, exporting the U.S. large language models to other countries. So from that perspective, I mean, these companies really are pioneering the build out of that AI infrastructure. In fact, NVIDIA said the hyperscalers will spend almost $600 billion in aggregate next year. So think of all the companies that are attending the dinner. That's where the $600 billion is coming from. So from that perspective, I think they would want to know the timeline and the ramp up of that AI data center.
It also just comes in such an interesting time for the regulatory landscape for these tech giants. We talked ad nauseum perhaps about the Google ruling yesterday. But what does it say at this moment where the AI is developing quicker than regulators can keep up? How much of this will be weighing on administration's mind that many people hoped would be more lax when it came to regulation?
Especially when it comes to the biases of the model. I think one of the concerns that was raised during election time was just, whether the social media is left-leaning or right-leaning. And so with the models, it's the same thing all over again. I mean, these models are trained on data, and you want to make sure that, they are as neutral as possible, and just how the models are trained and what are their biases, and those sort of questions are still very relevant.
Yeah, a very good point, Mandeep. Thank you so much for joining. Yeah. Thank you for that. That is Mandeep Singh of Bloomberg Intelligence. Also, Figma reporting its first earnings report after the bell yesterday, moving on that, where the company's sales outlook failed to meet Wall Street's lofty expectations. The stock is up more than 100% since going public in July and is down 16.5% in the pre-market. Bloomberg's Bailey Lipschultz joins me now. Bailey, we were talking about yesterday about what a big test this was for Figma. So did it fail that test?
It failed the test, Danny. I think in Spider-Man they said with high stock prices come high expectations, maybe something like that.
Yes.
But really, when you see a stock that rallies like this, you have to beat expectations. That's what we spoke about yesterday morning. You have to beat and raise. We saw revenue relatively in line with what Wall Street was looking for, and this is Wall Street that modestly is kind of, or for the most part, is kind of a hold equivalent on the stock. So when you don't beat those expectations, you have profitability falling short. That's why you're seeing the stock down so sharply this morning. Again, we've seen a lot of these momentum IPOs pulling back from their recent highs. So Figma really the latest, but again, you can't miss your first print after going public.
So you go public, you miss your first print. Bailey, we also talked about this idea that maybe a test for the general IPO market. Does it give people pause that, sure, you can get a 250% rally in your IPO, but you just steadily eat into that gain, especially if you can't show up with your earnings?
There's a lot of kind of debate around the current IPO environment. When you look at how these deals are being priced, when you look at how they're trading on day one, I think many bankers and investors would say 250% is not really what they want to see. It's a lot of momentum. There is a retail trader aspect at play with that kind of dynamic. The goal and kind of what we're going to see next week with a number of these deals pricing and debuting is, are we going to see banks push on price? Are we going to see kind of more modest opens? Are we going to see stocks that are up 20, 30, 40% and not 100 or 200%? Because most people would agree that's not really good for anyone.
Yeah, I mean, unless you're a shareholder who bought at the IPO and you're
sold.
Still up.
You had to sell.
And sold, or you're still up 100%. So that's not too bad. Bailey, thank you so much for joining Bloomberg's Bailey Lipschultz. All right, a quick check on futures. We're about 20 minutes away from the open, and we continue to gain. Some of those gains starting to peter out. A lot of mixed jobs data coming in. How do you handle that? How do you incorporate it? We still are within 1% away from all-time highs, even though we are little changed in this morning's pre-market session. And coming up, we're going to talk about this morning's data on a labor market, some of it pointing to cooling, some of it pointing to steady jobless claims. We're going to break it down and what it means for the Fed next. You're watching Bloomberg Open Interest.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get you some high-interest stories. A look at what's making headlines around the world. Apple planning to launch its own AI-powered web search tool next year. Sources tell us here at Bloomberg that the system will be integrated into Siri and eventually its Safari web browser. The underlying tech enabling it could come in part from Google. Apple is aiming to release the service in the spring as part of a long-delayed Siri overhaul. Elsewhere, HPE delivered better than expected sales and profit in the third quarter. The CEO said the company expects to weather narrowing profit margins as it enters a new era of AI-driven demand. And don't miss our conversation with HPE's CEO on Bloomberg Tech. That will be at 11:40 a.m. Eastern. Shares of American Eagle surging just under 28% in the pre-market. It reported higher than expected quarterly sales, and probably you can guess why. The success of its controversial ad campaign featuring actress Sydney Sweeney. They said they sold out literally of all of the jeans that she promoted. So thank you, Sydney Sweeney. Now, on the data front, initial jobless claims rise to their highest level since June. And even though it was steady, it did signal that the U.S. labor market might be cooling alongside an ADP report, which was also worse than expected. Bloomberg's Michael McKee, international economics and policy correspondent, joins us. Mike, a lot of jobs data coming in over the past 48 hours. What do you make of it?
Well, it's basically telling the same story, the same narrative, Danny, that the Fed has been looking at and that people on Wall Street have been talking about for a while, that companies are not hiring, but they're not firing too many either. 237 still a very low number in terms of jobless claims, but only 54,000 jobs created in the private sector, according to ADP last month. We'll see how that plays out when we get the non-farm payrolls number from the government tomorrow. Continuing claims fall, 1,940,000. That's 4,000 lower than they were the previous month. So it doesn't suggest a labor market in free fall. Might also note the trade balance widened, kind of expected, but it did show a big pull forward of imports during the month of July, and it suggests that people were again trying to get ahead of tariffs.
Then you also get that Challenger's job report, which has the weakest hiring plans for August on record. Mike, how does this set us up for tomorrow's non-farm payrolls?
Well, basically, we're looking at not much gain, 75,000. That is not a real firm estimate, I think, from people on Wall Street. They're willing to concede that we could go either way. We could see a strong report. We could see a weak report, and a lot of that may have to do with seasonal factors. But it's definitely a situation where people are expecting some weakness as the economy slows down. We also, of course, Danny, want to look at the revisions and see what we get after that 258,000 revision last month.
We will be looking at it, and the White House will be looking at it, Mike. Speaking of the White House, you're down in Washington, D.C., and Stephen Myron, in about 45 minutes' time, is going to be starting his confirmation hearing to see if the White House, which they want to do, can get him on the FOMC before this month's decision. What does the timeline and road ahead look like that for it to happen, Mike?
Well, it looks like it could happen because Republicans basically in the Senate will do whatever Donald Trump wants. It's not easy to do the way their calendar works, but it certainly could happen. Now, Myron is going to be questioned today by Democrats in particular over his stance on Fed independence. In his opening remarks, Myron pledges to use his economic background to make decisions, not his political background, saying the most important job of the central bank is to prevent depressions and hyperinflations. Independence of monetary policy is a critical element for its success. My opinions and decisions will be based on my analysis of the macroeconomy and what's best for its long-term stewardship. However, Myron did write a paper last year before he joined the CEA, which called for nationalizing the regional Fed banks and letting governors appoint the boards of directors who would then choose the bank presidents, which would inject politics into the Fed. He also says the president should be able to fire any Fed official at will, also political, and he looks for a major turnover of the Fed staff because the president can do that. So there'll be a lot of sharp questions about whether he's going to be too political for the job, but the Republicans have already indicated that he's not.
Mike, really looking forward to your coverage of that hearing. Again, kicks off in about 45 minutes' time. Bloomberg's Michael McKee in Washington. And again, he'll be there the next hour from Capitol Hill. Stephen Myron will be testifying before the Senate Banking Committee. All right, let's check on futures. Just 10 minutes away from the opening bell. We are within 1% of all-time highs, but we're a little changed on the S&P and NASDAQ, though looking to push for a second day of gains. Outperformance from small caps after they tumbled yesterday. Getting a help from this bond market, where the range yesterday was 11 basis points for the 10-year yield, jumping around quite a bit, but ending lower and pushing lower, again supporting some of the equities this morning. Speaking of getting jumpy, coming up next, investors apparently getting jumpy about Fed independence. That's the latest report from Wall Street. We're going to ask Morgan Stanley's Mike Wilson if he's seeing the same thing. This is Bloomberg Open Interest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Wall Street strategists say investors are becoming more concerned about Fed independence as President Trump seeks to impose his will on the central bank. JP Morgan analysts wrote to clients that, quote, markets have become more concerned over Fed independence as there are signs of a Fed inflation trade. Goldman Sachs analysts also noted growing concerns around Fed credibility. Let's get Morgan Stanley's take. Joining us now is Mike Wilson, who is the firm's chief U.S. equity strategist and CEO. Mike, thanks for joining this morning. Great to see you.
Great to see you.
So is this showing up in markets at all? At least on a headline level, there's been little drama.
Yeah, I think so. I mean, we've seen a little bit, maybe some term premium. I mean, in the bond market, I would say in the equity market, we haven't seen a major rotation yet to what I would say overly concerned about inflation running away from us. But this is part of a broader strategy. I mean, I think regardless of what happens with this particular event or, transition, the Fed and Treasury are working closer together and have been working more closely together because we have too much debt. Okay, and they've been doing this for, I would say, several presidents' terms and Treasury Secretaries' terms. And as I've been saying for quite a while, the Treasury is captured by Congress, right? Their job is to fund whatever Congress decides to spend. And the Fed, in many ways, is captured by Treasury's needs. So we've seen them work hand in glove in the past. And so that doesn't mean that they're, going to be manipulated and do something that's really crazy. But I think the Fed does have an obligation to help the government fund itself.
This is so interesting because there has been so much noise around Fed independence. Of course, we're going to get Steve Myron's hearing today in Washington, and their concern about Fed independence is what I'm basically hearing from you is it's not a concern, that you need a Fed who helps run this economy hot in order to tackle the deficit.
That's right. And by the way, I'd be nervous if the Fed wasn't somewhat totally independent because we do, the Fed needs to work to help us get out of this deficit problem. By the way, this is a bipartisan problem. This is not a Republican problem. It's not a Democrat. It's an American problem. We have too much debt. So the Fed should be working more closely with the government, with the administration to try and get our way out. And running the economy hot, as our note was titled this past week, is one of those strategies. So higher nominal GDP growth, maybe let inflation run a little bit hotter for a period of time, and then do more investment through tax incentives, and then hopefully you can kind of grow your way out of this debt.
Some people would say, though, that the risk with that is that you get the long end of the yield curve doing what it has been, and that is going higher, bumping up around 5%. What does it mean for equity outperformance? If running it hot helps equities, but potentially hiring long-term borrowing costs mean that it has the opposite effect of helping to loosen policy?
Well, that's right. And that's why I think the Treasury and the Fed together need to keep back-end rates lower, as they have in the past, right? So financial repression is not a new phenomena. There's different ways to do that, whether it's QE, yield curve control, they call it different things. But I'm pretty confident that if yields were to move back towards 5%, they would find a way to get them lower again.
So fiscal dominance means that in any of these circumstances, equities do well. Is that fair?
And to a point. I mean, look, they were priced for a lot of bad things in April, right? They were priced for a recession, which, by the way, in my view, I think we experienced a rolling recession that troughed in April. We've written about this extensively. And now we're into the next recovery. I call it a rolling recovery. So it's not going to be straight up for every sector. But the one part of the economy or one part of the market that has not really performed yet is the interest rate sensitive parts of the economy. Housing, areas that require borrowing costs to be lower. So that is the next stage of this. And I think, last week or 2 weeks ago, Jackson Hole, that's the first step to the Fed becoming more dovish. This is going to play out over the next 6 to 12 months. One of the reasons why we're still pretty bullish over the next 12 months.
Well, one of the things you write about that I think is so brilliant is this idea of a presidency that's kitchen sinked, much like CEOs who kitchen sink, get all the bad news out of the way. So the sequencing, is the bad news done then, Mike? Are we entering the period of deregulation, of tax benefits, and that adds rocket fuel to this equity market?
Absolutely. I mean, I think from a policy standpoint, the bad news is behind us. They sequenced it with a kitchen sink quarter in the first quarter that created a trough. And if you look at the policy, sort of initiatives from the administration and all the rhetoric starting really in middle of April, it was all pro-growth. They really flipped the switch, and I think that was intentional. I think that's a very out of consensus view still. So yeah, I mean, it's going to lead to, I think, somewhat of a boom next year in capex, in earnings. Corporations earning more money. They get a tax break now from the recent tax bill that was passed, and that recirculates into a higher velocity economy. The missing piece, once again, in this recovery is lower interest rates. That's the next phase.
But if it's all really concentrated in the first half of 2026, which we know the one big beautiful bill is, what happens when some of that juice starts to run out? When some of the capex spending on AI starts to run out? Does it mean a more challenging time at this time next year?
Well, to be determined. That's a story for another day. Right now, we're focused on the next 6 or 12 months. Now, I do think there's some risk in the short term for some corrective activity because it's been straight up. And I wouldn't even be surprised if we get a sell the news on the first Fed cut, like maybe back-end rates get away from them a little bit.
And you'd be buying those dips.
I'd be buying those dips, but I think over the next 6 to 12 months, I mean, it looks pretty darn good from an equity perspective.
Okay, Mike, stick with us. We have a lot more to discuss. That is Mike Wilson of Morgan Stanley, and we are just moments away from that opening bell. A look at futures heading higher, just ever so slightly. So again, we are within 1% away from all-time highs. S&P up 1/10, as is the Nasdaq 0.1% as the Russell 2000 outperforms with lower bond yields this morning. Your opening bell coming up next.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. It is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Just moments away from the start of trading, you're watching Bloomberg Open Interest. I'm Danny Berger. We are attempting to do a second day of gains, and at least if this price action holds, we will do just that. S&P and NASDAQ futures up 0.1%. Russell 2000 outperforms, getting some help from this bond market, which has been in rally mode since basically this time yesterday. We've had a lot of jobs data coming in over the past 48 hours, maybe mixed, maybe this low hire, low fire type of environment, but that's still supporting us. At the opening bell over the NASDAQ, we have IDEA. They are a bioscience firm. And then over here, we have Vontobel Asset Management, which, if I'm not mistaken, is a Swiss asset management firm, but they are celebrating the launch of their first ETF. All right, so we got the opening bell. Let's look at some of the price action of the major stocks this morning as they open up. Salesforce, that decline continuing. It is falling. Investors are seeking a stronger sales growth from its AI pivot. Figma, you can also see there, down 19%. It failed to meet a high bar for its first earnings report. And today, Broadcom's $730 billion rally will be tested with earnings after the bell. So that's the look of equities this morning. And again, this overall market continues to rally. Still with us is Morgan Stanley Chief U.S. Economist and Strategist Mike Wilson. So, Mike, we were just talking about how you're getting these strong tailwinds that you expect coming from policy, coming from an economy that might run hot. But if you look at the very moment we're in, we had ADP figures this morning that missed expectation. Challenger showing the worst August hiring plans on record. You also had the Beige Book saying that companies were fearful of hiring because of uncertainty. Is there some real tension at this moment between the macro outlook or the current macro environment we find ourselves in and equities near all-time highs?
I think there is, but when you actually look at what's been going on, I don't think there's any tension at all. I think you can explain this very simply, which is we're now getting all the lagging economic data on the economy, right? All that data is backward looking, particularly the labor data. And if you actually look at the revisions, right, the 2-month revisions, they all troughed in the second quarter with everything else that we look at, revision breadth for earnings, which are forward looking. Okay, so now if I had my druthers, okay, this would be the perfect setup. We get negative payrolls, we get some more negative labor data. The Fed goes, oh my goodness, we're actually in a recession. Every economist says we're in a recession, and then they really cut rates, okay? But the equity market's already figured this out 4 or 5 months ago, as usual. It's pricing forward, so we have a correction on that, but it's nothing like we saw in April. And then we resume the new bull market with a broadening out at that point. Because at that point, then the market can say definitively we're in an early cycle environment. The Fed's cutting, the yield curve steepens, and we get that real push through the broader economy.
Where does that broadening out happen? I'm just thinking about some of the earnings we had.
Yeah.
And you did see some of the retailers really flag some weakness and flag some issues when it came to tariffs. Walmart, for example, talking about higher prices every single week. Does the broadening out include them?
It does. Consumer good. I'll give you the list of areas I think that have been in a recession for really 3 years. Housing related, consumer goods, anything manufacturing related, okay, transportation stocks, particularly trucking and rails, commodity sectors have been in the doldrums, and then regional banks. There's been no C&I lending growth. So like there's a huge part of the economy which then will drive employment growth into 26 and 27 and also probably wage growth. So this has been a very unique economic cycle. I think we figured this out a while ago, this rolling recession. We didn't trade it perfectly throughout because it's been tricky. But now I have more conviction in that thesis that we are now in a rolling recovery from the trough of the recession that ended in April. And the Fed will be late because they look at economic data, which is backward looking, whereas the equity market is forward looking because it looks at things like revisions and earnings revisions.
If the broadening out happens, does it happen at the sake of tech leadership, or does tech leadership continue as the rest of the market also catches up?
Well, it's interesting, you know, tech has also been in a soft recession, XAI. So we could see now more spending on traditional IT, particularly software, some of the areas that we haven't seen upgrades since really the, you know, the work from home upgrade cycle. So you could actually see it broadening out within tech. As opposed to just 10 or 15 stocks that benefit from AI, now we actually see spending kind of diffuse across the broader economy.
So wait, so it's spending not necessarily on AI. Does some of the AI spending then, does that peter out?
Well, it's funny you mention that. We had a deceleration in AI CapEx starting last summer of 24, or something we wrote about. That also caused a slowdown in Q1. So we're not going to see negative growth in AI spending, and now we're actually seeing a re-acceleration. So I would argue that AI spending went through, you know, in their world, a mini recession, and now we're seeing a re-acceleration there. No, I'm growing more of the view that we're going to have a spending boom in 26 after this kind of continued softness through the rest of this year.
Mike, you just sound incredibly bullish. Is there anything that you're worried that could hamper this thesis that would make it not play out?
Well, I mean, if I can figure this out, the stock market's already figured it out. So that's the one thing that worries me a little bit, is that like the stock market already knows all of this. And so we have gotten ahead of ourselves on some valuation metrics. And look, this strategy is not without risks, right? I mean, this is a aggressive strategy to run the economy hotter to try and get out of this debt problem. And who knows if it's going to work perfectly? But I think this is our best chance of getting the debt down as a percentage of GDP.
So we get an economy that runs hot, again, this strategy, and it goes back to what you were saying, that you could get something like QE or something to make sure long-term bond yields come in. But if you do have a real clear working together of a Treasury, of a Fed, what about foreign buyers, not just on treasuries, but on American equity as well? Is there some damage to brand America because people have said Fed independence, it's sacrosanct, it's so important to the U.S.?
Well, I think there's a lot of things going on. I would say that maybe foreign investors shouldn't have as much capital in the U.S. because there's been this one-way freight train. The current account deficit's been negative, which means the capital account's been positive. So I would argue foreign investors probably own too much of the U.S., and diversifying back to their own economies is a good thing. One of the things that lower interest rates globally will do is it will stimulate the global economy, right? That's another area that's been in a recession for the last 3 years, is most of the global economy. So if that can come out of its doldrums, that can add to the, that can add to the story. And why can't foreign equities work in concert with U.S. equities?
Is there any tension of all this risk on happening in gold that is at all-time highs, of calls for gold to hit $5,000 by next year?
Well, I mean, gold has been probably the single best asset to have owned in the last 25 years, without question. But this gets back to the policies that we've had for the last 25 years, which is, print money, don't invest, okay, overconsume, pull forward demand, and basically not have any concern about, the long-term value of the dollar. So maybe over time we can grow. If we grow out of this problem, then gold will become less attractive of an asset relative to other things. But the reality is stocks are also a good hedge against this strategy, right? So what's worked the best over the last 25 years is high-quality stocks, okay, that can grow through this type of an environment, and basically fiat currency hedges like gold or even Bitcoin.
Yeah, sure. I mean, hey, in the inflationary environment post-COVID, stocks still did really well.
That's
so
right.
Speaks to that too. Mike, thank you so much for joining. This has been absolutely brilliant. That is Morgan Stanley Chief U.S. Equity Strategist and CIO, Mike Wilson. Let's get a check on the stock market just under 10 minutes into the trading day here in the U.S. And you have about even up and down stocks. Look, we are gaining, not to a huge amount, up about 0.2%. What is leading us there? It does seem to be some of the Mag 7 this morning. Recall that some of these CEOs are going to be in the White House at the new, apparently, concrete garden, Rose Garden. That's at least what Michael McKee tells me it now looks like. So Amazon, Meta, those shares are higher this morning, as is Broadcom. Remember that they are going to be reporting earnings after the bell today. On to the downside, we have also tech leading us lower. Apple, those shares down 0.5% this morning. Meanwhile, Salesforce, again, that takes the cake of the top decliner. They had earnings which disappointed. Does their AI offering finally pick up steam at some point? It would seem that they're getting a real challenge from companies who are going at it alone and incorporating their own AI. So that's a look at the individual names. Now, when it comes to sectors, again, we are at a moment where you are looking at a S&P that's just up 0.1%. It's interesting to see healthcare. So some of the kind of more safety trades this morning is lower. Consumer discretionary, that's at the top, up 1.5%. I got to be honest, Mike Wilson was talking about an expected broadening in this market. The trade kind of looks like that today. It's not info tech that's carrying us higher like it did yesterday. In fact, tech as a sector, you can see, is down 0.2%. But of course, the communication sector, which has a lot of Mag 7 in it as well, is also the second best performing sector. Okay, coming up on the show, Ollie's Bargain Outlet continues its expansion across the U.S. The company's CEO will be joining us next. You are watching Bloomberg Open Interest.
Now, your co-headquarters is in Miami, so you spend a lot of time in Miami and Florida. People often think the hedge fund world is centered in New York or London. Do you have enough access to talent and information in Miami, or does it make a difference anymore?
Information is, everywhere at this point. So information's not the challenge. I think young talent tends to want to be in New York. I'd say 75-25, just because the ecosystem of young people and social reasons. But we are having more big hedge funds, obviously Citadel being the most prominent, come down to Miami. And that causes management teams to increasingly come through Miami. So it is a perfectly good place to run a hedge fund, and there are many good hedge funds down there.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Let's get you some top calls, some of the analyst action in focus this morning. First up, MoffettNathanson upgrading Apple to neutral, seeing a limited downside as key headwinds continue to fade away. Apple weaker in today's trade. Next up, Seaport Global downgrading AMD to neutral. Shares fall 2.6%. They say recent channel checks indicate slowing progress within its AI accelerator business. Finally, Evercore upgrading Brinker to outperform. That highlights an attractive valuation and improving customer satisfaction measures. Shares up 5%. Now, price targets keep rising for Ollie's Bargain Outlet. Since reporting earnings last week, 10 analysts have raised targets by an average of 13%. The stock has been on an impressive run, up over 40% over the past year. Joining us now is Eric van der Valk, CEO of Ollie's Bargain Outlet, a U.S. discount retailer with more than 500 stores across 30 states. Eric, thank you so much for joining.
Thanks for having me, Danny.
So you also had your earnings last week. That looked very robust. I would love to know what's driving that. Is that consumers trading down to Ollie's, or is it already your current base just spending and robustness there?
It's all of the above. So we are seeing a trade down, very solid with low middle income and higher middle income consumers, and even high income. So we define that as 50 to 100,000 in household income, or even 100 to 150,000 household income. We're also seeing growth in younger consumers under 50 years old, which is great for us.
So with that, because there's a lot of questions as to when retailers report, is this something of a moment of economic stress? If you are seeing that down trading, does it to you indicate greater economic stress?
Perhaps. We do see that in the way customers are behaving, and our concern for customers as we enter the back half of the year that perhaps that pressure will intensify. In our business, we see customers shopping more intensely for consumable product, consumer staples, products they need. They're shopping close to need, which is an indicator that the consumer is under some stress.
Well, businesses under stress too, trying to figure out how to navigate tariffs. I think as the start of this year, it was something like 20% of your products were imports. Just the day-to-day of doing business with things like de minimis tariffs ending, confusion over what absolute levels are. How difficult is it to put a price tag on an item right now?
It's challenging, but our business model is very fluid and flexible, so we're in a great position. We can make a decision not to buy an item if we can't offer the right price to the consumer, and we could buy something else. Our customer doesn't have an expectation that we'll have anything in particular in stock on a day-to-day, week-to-week basis. That gives us the flexibility to just not buy it, not import it, if we can't achieve the right price and the right markup, ultimately to make us profitable.
Given that, again, you're just so known for value and discounts, does that mean that you are avoiding at all costs trying to raise prices, or are you doing that on the margin?
We are avoiding at all costs to raise prices, but we are a price follower, and we maintain price gaps to the market. We're fiercely committed to making sure we are the absolute best price in the market. It will continue to do that. Again, we can substitute items and even categories to ensure that we are the best price in the market and not necessarily follow the market in price increases.
On your earnings call, you also talked about this idea that bankruptcies and store closures that are happening right now are a big benefit to you too, because you can look into expanding into these spaces. Just the level that you're seeing at the moment, if we compare it to other moments of stress, I mean, the most recent of one being COVID, how does it stack up with these retailers that are closing and, again, advantages you're seeing there?
Sure, yeah, it's a great moment for us. 43 years of business for Ollie's, and there's always been enough closeouts in the market for us to be able to fuel the demand of our consumers. In this moment, it's bankruptcies and it's tariff-related uncertainty that's created even more closeouts. When you look at the market share opportunity for share of wallet with all the different companies that have closed, gone bankrupt, or closed stores, tremendous opportunity. It's also an opportunity to pick up people, human capital, people who are without jobs, and hire them into our new stores. We accelerated growth this year, opening 85 stores on top of 50 last year was an opportunity for us to hire more people and provide tremendous value to that many more communities across the country.
I have to say, Eric, I also think part of the reason it's so fascinating to be in your seat right now with a really iconic American brand started in the 1980s is that for so many brands closely tied to this country, you're seeing a real interest from the online community and from the president, be it calling out the Cracker Barrel change of logo or Sydney Sweeney selling jeans for American Eagle, which I'm going to assume you're not hiring any actresses to sell all these bargain brands. But how do you think about just approaching the public when it does seem like there is this greater awareness, again, be it from the White House or online, with what companies are doing?
Sure. Ollie is actually one of our founders. He's a real person, and his image is all throughout our stores. It's a very quirky, kind of funny, friendly brand, approachable. And Ollie is one of our founders, is, kind of funny looking older man. And we love him and our customers love him and we lean into him and have no plans to make any changes in terms of our iconography and our brand personality.
But again, when you think about changes, do you have in the back of your head potentially that this could have an audience of the White House? Does that factor into decision making at all?
It does not.
Okay.
It does not. No. We find it maybe humorous to talk about, but it's not really factoring into decisions that we make.
Hey,
Our
Eric,
customers give us feedback on Ollie. They love Ollie.
Well, just quickly on the customers, you don't want to raise prices. You can be really flexible. I just wonder what levers you're looking at pulling right now to deal with some of the tariffs on items that you do want. How are those conversations working with suppliers and elsewhere?
Sure. Our suppliers are great partners, and we have a tremendous buying acumen to work with them, partner with them to ensure that we can bring the right value to the marketplace. So they participate. Again, we choose potentially not to buy. We substitute items, and we watch very closely the price comparisons to make sure that our value gaps, our price gaps are maintained or even wider.
All right, Eric, thank you so much for joining, and I'm sure Ollie is happy with this interview that his face will stay the face of Ollie's. That is Eric Vander Valk of Ollie's Bargain Outlet. Now, coming up, speaking of American Eagle, those shares climbing to an intraday record.